Good morning. How's everybody doing? Good morning, good morning, good morning. It is a sunny day in Maine. Hopefully, you're all doing okay. Flow Money says hello. Ruby says hello. Says a hi. Mark is out for this week. Hopefully, he will be back next week. So if you're used to Mark, you got to wait a week. Got me. What I'm going to talk about today, I wrote about it in my my F Market newsletter. I'm trying to what is it? Market Action, my Market Action newsletter. I got to even think of the name. It's free. Tell at least one dad joke. I have to talk to my daughter. She has the best dad jokes. Attack of the Drones. Market Action. Thank you. Thank you. I don't even know the name of my own newsletter. Hannah's going to kill me. Anyway, so in that newsletter, I talked about an orbiting market. And today, what I want to do is I want to cover what we have right now. And probably for some, maybe some game plan people, you're having a good time. For my vol zones are kind of sitting here waiting in a zone to move. So there's a lot that's baked into the market not doing very much. So an orbiting market is another. I also have another fancy name for it. You guys ready for this? Right? Here, you want my fancy name? I invented this name, but it's called vol fatigue, volatility fatigue. Okay, and you're like, what's volatility fatigue? Okay, so I'll tell you what I can explain it. So I was a floor trader for a long time before I became an old guy and moved to Maine. But what happened is traders are in shock after an event, meaning recent history is in the back of their mind. How about everybody in here, right? Did anybody in here think we'd be back to 5,900 by June 1st when it was April 15th? Maybe some of you did. Some of you, I don't know if you're following me in the newsletter, you did the nibble strategy, right? Every week you bought some stock, which is what I did. Because you never know how long these things are going to go. So I just, okay, that's why I have cash. Go buy some stock. And then you trade, you're still trading, but you also want to take those big sell-offs for, opportunities to buy stocks. One of the stocks I bought was KTOS. It's up a little bit more today, a drone stock. I like that. It's one of my picks for the year. That stock is doing very well this year. They want those drones, but another topic. Maybe for Rip Zone people today. Who knows? We're doing equity vol today. So vol fatigue is basically when traders won't sell options, but the market won't move, and the market won't move. That's what that is. Okay. That's what vol fatigue is. So traders, here's another question for you. when the market is very active, for people in here that like to sell options or write calls, do you like writing calls when the market's going nuts? Let's say against your stock, market's down 7%, 8%. Does it make you just want to go out there and write some calls against the stocks that you already own? Do you ever do that? You're like, okay, market's down X%. I want to write some calls that are underwater relative to where my stock was. Nobody likes doing that, right? So what happens is all of a sudden the normal flow, remember how the market works. The market works on normal flows. Pension funds, hedge funds, retirement accounts. What do you do when the market's kind of not doing anything? You're like, all right, I'm going to write some calls that are 10% out of the money. Who cares if the stock goes up there, right? That provides contracts to the liquidity provider. That also is how volatility comes down. And when the market's going nuts, that normal flow is gone. Gone. Okay? So what happens is now we're left with volatility at a relatively higher level, but we're not moving as much anymore. And people are not quite creeping back into sell calls yet. Not quite there yet. Probably getting close though. So the way you figure these things out is the first thing about understanding what orbiting is in the first place is understanding what the straddle is. And I'll just tell you one of the things, there's lots of indicators, things to look at, but the straddle is always the best information today. Okay. I do love that authentic Maine background, JB. That's pretty nice. I feel like that's Popham Beach and that's a lighthouse back there. Nice. Yeah, there's a lot of lighthouses here, a lot of rocks. Right? Your straddle is the best information for today. What is a straddle? That is the at the money call and put added together. For the term for the term I am interested in. So the first thing you have to figure out is, okay, what's the straddle? All righty. VIX is 1839. Now, for those of you who have been here prior, every 16 points in VIX is a 1% move close to close. Every 16 points in VIX is a 1% move close to close. So I'm just going to write that down as a little memory jogger here. Okay. Every 16 points in VIX, right? VIX is 1848, so it's a little higher than 16. Every day for 30 days. Okay, so 32 points is 2%, 48, 3%, and on and on and on. 8 points in VIX is a 0.5% move every day on average. So when you're sitting here and you're looking at 1840, I'm like, okay, I'm looking for a 1% move. I'm looking at a 1% move in SPY. Are we getting that close to close? Is there any momentum in the market after that big, beautiful, okay, maybe we won't tariff the EU? No, although we are getting just a little bitty something here. Let's see if we hold up here. Right? Hold up, and that'll be one of the keys to what we're going to do today. But the idea is the market is expecting, like, okay, if I'm going to be this high of all, I should be closing up 1%. I should be closing down more, actually a little more than 1%, more like 1.25. I should be closing up there, down there, should be moving around. So your orbiting market is just this, up, down, up, down, going nowhere, going nowhere, going nowhere. Although all of a sudden we're starting, it looks like we might, right? We might be getting ready to break out a little bit. So your straddle is, so let's look to the end of the week here, which is the 6th. And they're like, the straddle is $8. Call and put $8. Now, for those of you that are looking at, do you think we're going to move $8 this week? Does that feel like an $8 move is coming? Right? Because that $8 move is 600 SPY. You're like, dang, man, we're down 10 cents today. We ain't moving $8 this week. We haven't been able to do $8. No way, no how, no nothing. So the market is like, listen, we're going to price this here. Come and sell it to us. So if the volatility is still staying this high, is anybody selling to the liquidity provider right now? Is anybody selling? Okay. Are traders selling that short-term volatility to press that straddle price down right now? No. Okay. So we are stuck with higher option prices, right? But we're not moving anywhere sustained. Meaning we're up a little, down a little, but we get nowhere. What is a close to close move? So a close to close move is the close yesterday to the close today. Right now, what are we doing? Okay. What are we doing? Is there any close to close move here at all? Is this an 18 volatility market today, the first half hour, 45 minutes of the day? We're up 2 ticks, 17, 14, 15 ticks, whatever, nothing. This ain't no volatility. So a close to close move, right? That is called realized volatility. And in an orbiting market, that number is way below. So if I'm moving at close to close volatility is only 4 points a day SPY. I'm sorry, 1 point, 2 points, 3 points. We're down to like, it would be like an 8 VIX, a 7 VIX, a 9 VIX, a 12 VIX. We have very low close to close moves. So our realized volatility is far, far, far below what the market is pricing for 30 days. So that's, you go from a straddle telling you how much we expect to move over a period of time to a realized volatility, actually how much we're moving over that period of time. Okay. So our orbiting market, right? Our orbiting market is a combination of several factors, right? So we have what I would just call higher implied vol. Okay, those are just option prices. Implied volatility are just option prices. Okay, they're just option prices for the same period of time. Now, have you ever wondered, you want to change the way you trade options? Think about it in terms of time. Voz with the game plan. Okay. Time. Here's my plan for the day. Here's a trade for the day. Going to move through this. Got to move through this in a period of time. Time helps you because time is part of what makes options. It goes into the price of options. It is part of the calculation. It's one of the moving parts. Right? You will change the way you trade when you start thinking about how long you want to be in a trade. Not just where it's going, but how long you actually want to stay in the trade to see if it's worthwhile. And that's why with an orbiting market, or the concept of it, right now, in my view, they're making you pay a little bit more for time because we're not really doing very much. You're being charged more for time in an orbiting market. I'll just write it here, right? All that is just I'm charged, right? Retail traders are charged more for time. So other strategies like flies and calendar spreads, diagonal spreads, things like that probably work a little better when you have a market that looks like this. It's for another time, and for some of the option pick classes. Again, if you have a short enough time period and you have action in that time period, you just buy a call or a put. It works, right? Like game plan. Because you've got to break into something, execute a trade, and then you're out of it relatively fast. Buying an option is the easiest way to do that. If you want to trade things over a long, different time frames, right? Or try to make bigger compounded gains, you generally need more time for the underlying to move. So the second part of an orbiting market is there's really the day ends where the day started. Just not going anywhere. The market cannot get out of its own way. I think Leisha calls this like it's coiling, right? That's the term? I'm not much of a technical analyst like she is, but you have a coiling market. Now, generally, here's your hint. Markets don't stay coiled like that forever at a high vol. Okay. So you're not getting really any of that, again, that continuation of movement. Okay. And then again, in my experience, looking at the market for a while, 35 years, or I don't even want to say how long it is anymore, but right, the market does not, an orbiting market does not stay that way forever. It will break out. We'll break out. We will. Or up. Okay. So from an orbiting market point of view, on higher implied volatility, traders are charging more for time, especially in the short term. Like 1 week options. Okay. The day generally ends where the day started. Today, we kind of got that going on. Individual equities can still move, right? Like the news in CEG this morning, Meta buying a lot of time. Sorry, that's an airboat going by. All that kind of, you're getting some movement in the nuclear stocks. KTOS stock I like moving a little bit. Big beneficiary of the drone land. Stocks can move, but the broader market indexes can be stuck a bit. So we generally end the day somewhere where we started, well within, right? Well within that implied that VIX move. Okay, so that's well within the VIX move. Now, and then the last part of this is we just don't stay that way that long because, again, the implied, it's all usually, and I'll put this here at the beginning, we're coming off a shock. And that shock could be anything. There we go. Took me a while to figure it out. Coming off a market shock, meaning usually that's a shock down. So you kind of have this thing there, you're like, okay, we got to wait to see the dust clears and then we'll pile in. Right? You need those willing sellers to come back. Okay. And this is really where you start to see, so what do you look out for? Right? Okay. So here's some things you look out for. All right. Change in skew. Here we go. More funky technical terms. But change in skew is like, okay, are traders starting to sell the 4,000? Like example here. Okay. Are traders selling, right, the 5,000 puts in SPX again? Okay. Remember, you need margin for that. It's free money. 900 points away. If they start selling that, if hedge funds and stuff start selling that, they start selling those, or they start selling the 6,500 calls or the 6,300 calls. That's all. It's going to start moving the skew. It's going to move those out of the money options, and they're going to start to decline in value a little bit. That's how the volatility starts to come in a little, how should we say it? A little momentum will help kick in because, so again, for volatility to come down in the market in mass, you need sellers to come in, option sellers to come in and bring that vol down. And that's how it happens. So the good thing about an orbiting market is it does lead to a break up or a breakout, or I say breakout or breakdown, I should say. Now, right now, what's another thing to take a look at? Okay, real easy here. Direction of VIX. Okay, is it up or down? Okay, right now, VIX is not doing a lot, right? It's hanging right at a zone. Okay, are we breaking into a new lower zone, right? Breaking into a new zone. 18 is the difference between zone 2 and zone 3. Right now, we are stubbornly hanging on this, like right in the middle for 3 weeks. We had about a 1 to 2 day blast out, and ever since we got into zone 4 for a little while, and then we quickly retreated all the way back down to sit here in this middle for everybody, for traders to wait. Okay. Now, like I said, the expected move here for whatever reason for this week is around $8, and around $8 gets us to around 600 SPY. I have no idea. My guess is the market is anticipating some kind of trade news. If it's any kind of good, we go ripping back to 600 SPY this week. That's my guess. So where that leaves us is, and I'll answer questions here in the last 5 minutes, right? Breaking into a new zone. Here's the last one here, direction of VVIX. So you can follow these indicators, right? Okay. And I'll write down my zones here real fast for you. Right. So we got, hopefully some of you should know about around 9 to 13. Okay. We got 13 to 18. Okay. We got 18 to 23 and 24 and higher. Okay. I'll call this there. So basically, this is how volatility in the S&P 500 operates in these quartiles. Remember, this is data going over a very long period of time, basically since the OEX days when it was OVX was the indicator back in the mid-80s. So this is a very long stretch of time. This year, we've spent almost the entire year in zone 3 and 4. Almost the entire, very little time in zone 2. Right? Historically, not. We've had a lot of market activity in 2 and 3 and 4 since COVID. And again, I believe one of the reasons is extraordinary government spending and just blowing the market up, blowing the market down, whatever. It's a lot, right? Much more so than the volatility I remember from 10, 15, 20, even 30 years ago. You get little bouts of volatility, but nothing like the sustained stuff that we've had in the last 4 years. It's pretty high. Again, pushing my zones again higher, maybe a little higher, but I still think these are we're still valid where we are. We just haven't seen zone 1 really we've had usually have like, 3 months a year in zone 1, 3 months a year in zone 2, 3 months a year in 3, 3 months a year in 4. Right. Yeah. Summer months, holidays, stuff like that, pushing the vol down. You got crazy news, whatever, panic, zone 4. Again, this is like historically kind of how things work. Direction of VVIX and direction of 9-day VIX, right? So direction. So these are all things if you want to look to see what the market, how it's leaning. Okay, so if I look at here, if we go VVIX, all right, we're going to go VVIX. And I believe TOS, most platforms have this. You just have to use the right amount of time. All right. Okay, again, this was that hard rally we had last week. And then down here, again, not a recipe. This is a pretty whatever the news that we had, I believe the Russian thing, Ukraine's maybe stalemate possibly from the weekend, but definitely solid drop. This is the volatility of VVIX, solid drop. Again, it's hard for the market to fall apart when there's the demand for VIX options is going down. It's hard. Not going to say it can't happen, but that's the trend is down. That vol trend is down. 9-day volatility, we're at 17.5. Again, creeping down. So this was a little weekend affected here. I believe we had the 3-day weekend. So here, or was that last week? I can't even remember anymore. Do we have a 3-day? What's today? Tuesday. So this was the 3 to 8 coming off the Friday, Monday. Yeah. So we had a normal weekend this weekend. But that was a pretty hard drop. And recovered, but now it's giving it all the way back, going back down again. So again, the trend for short-term volatility, again, orbiting, not really picking up a trend. We had a little bit, but then again, the weekend. But for the most part, since we had those highs, not breaking into any new lows. And that's what you want to see. You want to see some new lows. So right now, I would say we are still stuck right there. Still stuck right there. This is the vol of VIX. Again, we'll get this PDF for you. Okay. And this is VIX on a 9-day calculation. 9-day options. Remember, VIX is 30 days. 9-day VIX is using 9-day options, basically 2 weeks. So this is our, again, orbiting market. This is what we have. How long can we stay like this? For a while, until the market grabs some piece of news in general that feels like the worst is over. It's kind of like, it's just how it trades. There's still, some inflation, interest rates, all that kind of stuff is still kind of lingering around a little bit. So I'll put this out as maybe I'll give you a picture of a straddle here. What? And here's a little straddle picture. All right, so most platforms are going to have the straddle lit up like that at the money. Like they're saying, hey, at the money's right here. That's what it's saying, at the money's right here. All right, so let's see if we have any questions now before I let everybody go. And I feel like the market is poised to go up. I don't know why it wants to go up, but that's where it feels like it is. Zone 1 is 9 through 13. Yes, Real Ranger. Yes. Sniper's question. Aren't there two major considerations for term selection for buying premium? Expectation for time of the target and time decay over the term? Oh, absolutely, Sniper, for sure. But I think part of the problem is nobody considers time in their trade. All they're looking for is, I think the stock's going up, I'm going to buy some calls. Right? So what I say is, okay, you think the stock's going up, how long are you going to be in realistically? Will your trade pay in that period of time? Choppiness in SPY is a relatively high, indicating a consolidating condition. I agree. Do you ever take a straddle on future options? Don, I do not trade futures anymore. I haven't traded them for a long time. All of this stuff applies to future option trading. You just have to be keyed in. Like I trade VIX future, the VIX future options. You have to be keyed in onto how your product settles. So whatever future you're trading, the options you're trading, like if you're trading corn or bonds or something like that, you got to make sure you understand, be aware of how that future settles. Does that make sense? But you can, like, I know option future traders, this is what they do. Right? All that option stuff works even with futures. The difference is with futures, you don't have, corn prices don't go up forever. Right? So there's a little more range bound action in them, and there's a lot of skew in future options for that reason, right? Because of the breakout pricing. NQ is fine. So that's more just straight up equity stuff. So this is portable to straight equities, Don. The PDFs will come out. Our crackerjack team of marketing people will make it look a little nicer, and it will go out with the recording of this video to everybody who has signed up on our list. For a replay. Hey, catch the replay. So again, if you want to, if you want more information about kind of the idea of using ranges in trades, Voz is doing that in Game Zone. She's like been incredibly successful. Check it out. Market's moving. Okay. Is there an event in January causing the anomaly in the VIX curve? That is just the holiday, Jerry. So the VIX curve and the holiday is just holiday stuff, basically. So what you'll see is you're going to see a couple wrinkles in the VIX curve. It's usually an event. And it's mostly just because of this is around Christmas. So what happens when you see a kink is it's usually around a holiday. It's screwing up the calculation somewhat, like the 4th of July. Here, it's just Christmas. Okay, so now you know an orbiting market. Here's the thing. They'll break out eventually. So you got to, the biggest problem is time decay. I'll just say biggest problem. Time decay is the biggest problem. Vicky's saying like the election. Yeah, the election last year, that October future never went down. Never went down. And it's because the implied volatility in the back just held it up and up and up and up and up forever. And then it went down the day after the election. The October had already expired, obviously, but all collapsed then. But it has not happened yet. We are still, I think, in our vol event from April 4th. in my view, we are not out of it yet. We're getting to the bottom end of it, but we're not out of it yet. All right. That is our orbiting market. I wish we were not in an orbiting market, going up hard or down hard or something with a little more excitement, but that's what we got. So it's better for you to understand what you got. This is how you figure it out. And hopefully it was helpful. We'll see some of you in Rip Zone, some of you in Delta Strike, some of you in Cap Gains today. Have an excellent day. Summer's coming. Bye-bye, everybody.